In today's video, we're breaking down the essential stock market terms that every beginner must understand before investing. To keep things clear and easy to follow, everything is organized into 9 simple sections. So, if you've ever felt confused about how the stock market actually works or struggled with investing vocabulary, you're in the right place. Welcome to Thin Ed, where we simplify investing so anyone can understand it. Let's start with the foundation. What is a stock? A stock represents partial ownership in a company. When you buy a stock, you're buying a small piece of that business. There are 2 primary types of stock, common and preferred. Common stock is what most people invest in. It gives you a share of the company's success and usually voting rights, but dividends aren't guaranteed. Preferred stock works differently. You typically don't get voting power, but you often receive more consistent dividend payments and get paid first if the company distributes profits. Rather than owning just one stock, most investors hold multiple investments together. This collection is called a portfolio. Some of the companies in a portfolio may pay dividends, which are cash payments companies distribute to shareholders from their profits. Not all companies are available for public investing. A public company has its shares listed on a stock exchange, while a private company keeps ownership limited to founders or private investors. To track how groups of stocks perform, investors use market indexes. An index is a group of stocks designed to represent a specific segment of the market and is often used as a performance benchmark. For example, the S&P 500 follows 500 of the largest U.S. companies. The Nasdaq is heavily focused on technology stocks, and the Russell 2000 tracks smaller businesses. When people say they're trying to beat the market, they usually mean outperforming one of these indexes, most often the S&P 500. Since it's considered the standard benchmark, exceeding its returns is difficult and achieved by a small percentage of investors. Stocks are bought and sold on a stock exchange, which is the marketplace for trading shares. The largest U.S. exchange is the New York Stock Exchange. To access these markets, you need a brokerage, which is a platform that executes trades on your behalf. Some brokerages charge a commission, which is simply a transaction fee. Each stock has a unique identifier called a ticker symbol, like AAPL for Apple or AMZN for Amazon. Trading takes place during market hours, usually from 9:30 a.m. to 4 p.m. Eastern Time. The stock price is the current value of one share. The opening price is where the stock starts the day, and the closing price is where it ends. Outside regular hours, trading can still occur during pre-market and after-hour sessions, often driven by earnings announcements or breaking news. These periods usually have lower volume and liquidity. Volume shows how many shares are being traded. Higher volume means more activity. Liquidity measures how easily a stock can be bought or sold without causing large price changes. Large companies like Apple or Microsoft tend to be very liquid.
Now let's talk company valuation. Market capitalization is the total market value of a company's shares, calculated by multiplying share price by total shares outstanding. Enterprise value goes deeper by factoring in debt and cash, giving a more complete picture of a company's worth. Revenue is the total money a company earns from sales. After expenses are deducted, what remains is net income or profit. On a company's balance sheet, assets represent what the company owns, while liabilities represent what it owes. To compare companies, investors rely on financial ratios. Earnings per share, or EPS, shows how much profit is generated per share. The price-to-earnings ratio, P to E, compares a stock's price to its earnings to help assess valuation. The PEG ratio adjusts the PE ratio for growth, making it useful when evaluating fast-growing companies. Income-focused investors often look at dividend yield, which shows dividend income relative to the stock's price. Free cash flow measures how much cash a company has left after expenses and investments, money that can fund dividends, buybacks, or expansion. Profitability is measured using margins. Gross margin shows profit after production costs. Operating margin accounts for business expenses like salaries and rent. Net profit margin is the bottom line, what's left after all costs, taxes, and interest. Stocks also fall into different categories. Growth stocks are companies expected to expand rapidly and typically reinvest profits instead of paying dividends. Value stocks appear undervalued based on fundamentals, attracting investors who believe the market will eventually correct the price. Blue chip stocks are large, established companies with strong reputations and stable performance. Cyclical stocks rise and fall with the economy, while defensive stocks tend to remain stable because they provide essential goods and services. Companies are also classified by size. Large-cap companies exceed $10 billion in value. Mid-cap companies range from $2 to $10 billion, and small-cap companies fall below $2 billion. Penny stocks are low-priced shares, often under $5, and carry high risk. Investment funds provide diversification. A mutual fund pools money from many investors and is managed by professionals. An ETF, or exchange-traded fund, trades like a stock and can be bought or sold throughout the day. An index fund tracks a market index and aims to match its performance with low fees. More complex options include hedge funds, which use advanced strategies and are typically reserved for wealthy investors. There are also tax-advantaged accounts like a Roth IRA, where investments grow tax-free if certain rules are followed. Beyond stocks, investors can access commodities like gold and oil, bonds, which are loans that pay interest, currencies, and cryptocurrencies such as Bitcoin and Ethereum. Market behavior matters too. Volatility measures how much prices fluctuate. The VIX, often called the Fear Index, estimates expected market volatility. A bull market is marked by rising prices and optimism, while a bear market involves falling prices and pessimism. A correction is a temporary drop of around 10%, while a rally is a sharp rebound. A crash is a sudden, severe market decline. Market bubbles occur when prices rise far beyond actual value before eventually collapsing. Investment strategies vary. Passive investing focuses on long-term growth using index funds. Dollar-cost averaging spreads investments over time, while lump sum investing puts money in all at once. Active investing involves finding undervalued stocks and trying to time the market. Some investors analyze fundamentals, others rely on technical charts, and some focus on economic trends through macro analysis. Corporate actions like IPOs, stock splits, buybacks, and acquisitions can also impact stock prices. Risk management is critical. Diversification spreads risk, while asset allocation determines how money is divided among assets. Rebalancing keeps portfolios aligned over time. Metrics like alpha, beta, Sharpe ratio, and correlation help measure performance and risk. Finally, understanding economic forces like inflation, deflation, recessions, and government policies is essential. Monetary policy is controlled by central banks, while fiscal policy involves government spending and taxes. And that brings us to the end of today's video. The goal wasn't to master every term, but to give beginners a strong foundation in stock market language. Understanding these terms is just the first step. The real challenge is deciding which investments actually belong in your portfolio. If you want to see how all of this works in the real world, I've linked my ETF portfolio below. It includes documented performance and shows exactly how I put these concepts into practice. If you found this helpful, make sure to like the video and subscribe to FinEd for more content like this. Thanks for watching, and I'll see you in the next one.